Bloomberg News.
Joining us on the phone is Marc Faber, publisher of the Gloom, Boom, and Doom report and managing director of Marc Faber Limited. Marc, thanks for coming on the show. I want to point out quickly, we're getting some headlines coming across. Fed sets up swaps with Brazil, South Korea, Singapore, and Mexico. $120 billion in swap lines with those four countries. But it's not really, they're red headlines, but it's not really very shocking anymore to see the Fed pushing out more and more liquidity. Are you impressed with the job that Ben Bernanke is doing?
I think Mr. Bernanke is a disaster.
Do you think, I mean, is there any way that he could do something that would make you happy here, or have you been disappointed with every single move of pumping more liquidity into the system and cutting rates the way he has been?
If he were to resign, he would make me very happy.
But you must have seen this coming, though.
Person. I beg your pardon?
But you must have seen this coming. I mean, you've been forecasting every move that he's made.
Yes, but let's put it this way. 2 days ago, I thought the market was ready to have an explosive rally on the upside because the technical position was a disaster. It looked like a descending triangle. And when you have a descending triangle in the market and it doesn't happen, then the counter move is very strong. But it doesn't mean that the market has bottomed out for good. I think what we'll have is a 20% rally. Say the low on the S&P was around 739. We can easily go to 1100, 1200. But after that, I think we'll drift again like in Japan. Don't forget the Japanese market is at a 26-year low.
So what do you think that Bernanke and the Fed should have done? I mean, you expected, I remember when you called the rally that we had yesterday, but you expected also the rate cut today. So what do you think would have been a better move?
Well, I think, basically the Treasury and the Fed are intervening into the free market. And any intervention has unintended consequences. Like today, the dollar was very weak. And I think that in nominal terms, maybe the Fed can stabilize the market or even push it higher. If they print enough money, like in Zimbabwe, the Dow Jones can go to 100,000, but against gold and against the euro, it will fall.
But, of course, today we're seeing, I mean, gold is only $750 an ounce, and people are talking more about deflation than Zimbabwean inflation.
Yes. First, the problem with the Federal Reserve is that it created huge volatility. Let me give you an example. The CRB, which is the Commodities Index, peaked out in May 2006 at 365. Then it went down and traded around 300 until the rate cuts came. Then it sought to force 173. And from 473, it now collapsed to 274 as of today. Today it was up 15 points. The point I'd like to make is that the interventions of the Federal Reserve and the Treasury have made markets more volatile than they would have been if there hadn't been any interventions. It's the same like banning short sales. What it did is a lot of people, they used to hedge their positions. Banning the short sales made them liquidate their positions because they couldn't hedge it anymore.
Don't you think there would have been a problem, though, with the frozen credit markets if the Fed hadn't come in and done anything?
The best would have been if the Fed hadn't done anything after 1990. The bailout of Mexico, of LTCM, of printing money ahead of Y2K, and then lowering the Fed fund rate to 1% after 2001 created a total mispricing of capital and led to the credit bubble we have today. That is the problem.
Okay, Marc, listen, I'm going to ask...
Now you're asking the pilots who crashed the...
I saw you call the rally that we had yesterday. Do you think that we're going to see a medium-sized rally here over a couple of days, a couple of weeks, or were you thinking just one quick pop and then back down?
No, I think we're going to get a 3 to 6 months rally, simply because the Fed and the Treasury will do everything they can to boost asset prices. That's the only thing they know. And the Treasury Secretary has an interest to boost Goldman Sachs stock, and Mr. Bernanke, he's a money printer. He doesn't know anything else. I wouldn't hire Mr. Bernanke as my gardener. He's an intelligent man. Everything is okay. He's an academic, but he doesn't know economics.
Do you think that we're going to see then inflation coming alongside this 3 to 6 month rally? I mean, does it move right up here then?
First, I think we have a bout of deflation, and then we'll have a lot of inflation worldwide. I mean, enormous.
What kind? Are you talking double-digit inflation here? And what happens to the economy alongside? Are you talking about double-digit inflation, and what happens to the economy alongside that?
The problem is, if you have high inflation, like in the Weimar Republic or in Latin America in the 1980s, in real terms, incomes go down for the majority of people, but some people, the elite, can benefit. And this has been happening over the last 7 years. The wealth has shifted to asset managers and hedge fund managers, not this year, but in the last 7 years. And now, because they created the problem, they try to solve the problem with the same medicine, printing money. And I tell you, it will end badly, with huge social implications.
What do you think about the political situation in the U.S.? Do you think that we need a little change here? We're going to get a little change here? Is that good? Because I hear you talking about social inequities.
Well, quite frankly, when I look at the two presidential candidates, I don't think they're very bullish for the market. But I think a victory by Mr. McCain would be more positive for the market than Mr. Obama. But I don't think that whole life evolves around a stock market, because most people, I mean the majority of people, 80% of the people are not in the stock market. They are about their daily lives. They work.
All right. Marc Faber, thank you so much for joining us. Marc Faber there.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2000.